What is insurable interest? Why must there be a reason and justification for the amount of life insurance, the death benefit being applied for? Get ready. In this episode, I'm going to help you understand the relationship that must be proven between the insured and the beneficiary, that there must be an economic loss that's going to be suffered by the beneficiary in the amount of insurance. And once the policy is approved, you can change the beneficiary. But you must do this when you're applying for the contract. So get ready. You're going to gain insights into maybe some opportunities you didn't know existed before. I'm Doug Andrew, and I've been helping thousands of Americans now for 5 decades optimize their assets by increasing liquidity, safety, rate of return, and the tax benefits on those assets and minimizing taxes, okay? Now, when we say asset optimization, there's a lot of different places that you can have money. And in general, there's 3 houses, okay? Money has to have a home. Real estate might be one, and it's a moderate risk one. You have the stock market. Those are the markets where you have volatility. And so in the story of the 3 little pigs, these 3 houses, real estate might be the house of sticks, whereas the stock market might be the house of straw, because the big bad wolf can blow down the stock market in one day. The stock market has dropped 30 points in 1 month. 30% in 1 month, okay? Sometimes several hundred points in one day. The real estate market isn't quite so volatile, so it's like a house of sticks, but it can still drop significantly in downturns, like 2008. I choose to put my serious cash safely tucked in a house of bricks, but I am able to participate when the stock market does well without my money actually housed in the stock market. That's called indexing. I own real estate, and I participate when my real estate appreciates and goes up in value, but I don't lose when the real estate goes down, because I don't keep my money in the real estate. I own and control assets with very little or none of my money tied up or at risk in the asset. That's called leverage, but leverage without liquidity is stupidity. So I keep my money liquid over in the house of bricks in a max-funded IUL, okay? And so when you're taking out an IUL policy to be used for living benefits, especially high net worth individuals, affluent people, they're doing it because of what it does, okay? Nothing else in the Internal Revenue Code accumulates your money totally income tax free and then allows you to access that money totally income tax free, including all the gain, even before the age of 59 and a half with no penalties. And then at the end of the day, anything you leave behind usually blossoms and transfers income tax free. Nothing else in the Internal Revenue Code does that. And if you're not familiar with what I'm talking about, search other educational episodes on my channel. We're talking about Internal Revenue Code sections 72E, 7702, and 101A, okay? And you have to comply with 3 tax citations called TEFRA, DEFRA, and TEMRA. So suffice it to say, when you jump through those IRS hoops, it turns into an incredible tool where you can put in a lot of money and become self-insured sooner than later, to where your cash values grow to equal and exceed the death benefit, maybe as soon as 10 or 11 years into the contract. And now it's just zinging along, and this is what allows you to grow your money so that every $1 million that's tax-free can generate $100,000 a year of tax-free income without depleting principal. That's a nice payout, 10%. Most advisors tell their clients, don't you take out more than 4% a year. Why? Because Dalbar, who studies investor behavior, says that most people who have their money in the market are only really averaging about 3.5% rates of return, because they're buying and selling at the wrong times. And then when the market starts to go down 20 and 30%, people say enough already, and they sell low, and they wait, and buy high. No, you don't do that. If you use indexed universal life, indexing actually allows you to buy low and sell high, the opposite. And a lot of advisors don't understand that. But that's why you would look at using a max-funded IUL. It's not so much for the insurance, even though the insurance comes along for the ride. You're trying to use it for a living benefit of tax-free growth, tax-free income. But at the end of the day, when you finally pass away, it's going to blossom and transfer out tax-free in a death benefit. Now, when you apply for it, you have to submit an application to the insurance company, and you'll find out, watching other educational episodes, it's got to be underwritten, okay? You've got to qualify health-wise. But it doesn't matter how old you are or how unhealthy you are. If you get rated, you can still squeeze down the death benefit so that your rate of return is the same as if you were 25 years old. It doesn't matter. If you're older, it's not more expensive. It's the same. And a lot of agents don't understand how to do what I just said. But if you wanted to reposition 500,000, a million, 5 million, 10 million, what you're doing is you're submitting an application for the amount of insurance the IRS says you have to have in order to accumulate your money tax-free. Now, for older people, let's say a 60-year-old, that's usually double what you want to reposition. If you want to reposition $1 million, you're going to need to have $2 million of life insurance. If you're going to reposition $5 million to increase liquidity, safety, rate of return, you have to have $10 million of life insurance. Now, pretty soon, whatever you put in there, in that example that I just left off with, if you put in 5 million, that 5 million is going to double to 10 million probably within the first 10 years. Well, that means that there is no cost of the insurance anymore because you've self-insured. But it's tax-free. But there is still a risk at the outset when you first apply. If you died one day after you were approved and you paid the first amount of money into it, they're on the hook to pay out $10 million. If you took out $1 million one, they're on the hook to pay out $1 million, even though you only put in 10,000 or 100,000. So the insurance company's got to make sure they can handle that risk. So when you apply, you have to name on the policy, okay, this is who the owner is going to be. And normally the owner is the insured, but it doesn't have to be. I have episodes that talk about that concept. But see, the insured is the party that the insurance is on. Normally, the insured is the owner and the premium payor, but doesn't have to be. But when you submit the application, no matter who the owner is, no matter who the premium payor is, the insured has to prove, or the owner, the applicant, has to prove that when the insured dies, okay, that the named beneficiary on the application that's receiving the death benefit, that's the beneficiary, they have to prove that that beneficiary is deserving of that $10 million of life insurance, because otherwise they would suffer an economic loss equal to $10 million because you died. That's called an insurable interest. That's called the reason and justification for the death benefit. So if the death benefit's $1 million, 5 million, 10 million, when you submit the application, you have to show that whoever you're naming is the beneficiary. Now, it could be a family trust. It could be a bank that you owe money to. Okay? It could be your children, your dependents, your grandkids. So whoever you name as the beneficiary, you have to prove that they would suffer a loss equal to the death benefit. If not, you're not approved. So that's called insurable interest. So when you submit an application, make absolutely sure that you have a real professional will submit a little cover letter, and it usually starts out, the reason and justification for the amount of insurance being applied for is for the purposes of the beneficiary will be suffering that much of a loss due to possible estate taxes, loss of income because the person has passed away. They're going to have to deal with taking over the business, and it's going to take a while to learn the new ropes in the business. This money would have been provided by the insured had they stayed around and lived. But if they die, the business is going to suffer, the kids are going to suffer, the family's going to suffer, the bank's not going to be paid off, the mortgage isn't going to be paid off. And so you have to have a reason and justification for the amount of insurance being applied for between the insured and the beneficiary. Now, after you get approval, the owner calls the shots. The owner can change the beneficiary to a charity because it's pretty hard to prove, well, this charity is going to suffer a $5 million loss if the insured dies. Not really. But if the insured can prove that there's an economic loss suffered by this beneficiary, the family trust, but then the family trust wants to benefit a charity, they can change the beneficiary to a charity, and now the charity gets $5 million or $2 million of the $5 million when the insured dies, because the owner can change the beneficiary. But you've got to get it approved in the first place. So hopefully that helps you understand what the significance is and why there must be an insurable interest. Once you've sort of dotted those I's and crossed those T's and you get it approved, you can change the beneficiary to somebody who would be very difficult to prove an insurable interest or that an economic loss would be suffered by virtue of the insured's death. And so sometimes it helps to make sure you understand the purpose so that you can accomplish it by making sure that you prove an insurable interest when you're applying for the policy. Does that make sense? You don't lie, you don't, but you're showing the real insurable interest, the reason and justification. And once that's true, the owner could change the beneficiary if they chose. Does that make sense? If you want to learn more about the significance of terms like this, if you're a member of the general public, I would recommend you study my book, The Laser Fund. If you are an agent, I would recommend that you check out IUL Insiders, which is a coalition and network where we train many. And let me connect the dots here. So if you're a member of the general public or even an advisor, claim a copy of my book, The Laser Fund. It retails on Amazon for $20. If you buy it on Amazon, thank you. But I'll gift you a copy free. Simply click on the link below, laserfund.com. And when you go into that site, you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. And I'll fire out a hard copy of this 300-page book to you. And it's actually 2 books in one, 200 pages left brain. 100 pages right brain stories, okay? Now, when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats. But there's also a chance to schedule a quick consultation with no cost or obligation with a certified IUL professional. And I would recommend you do that so that you can see how these strategies apply in your particular set of circumstances. If you're a professional, you may want to check out how you can become a certified IUL professional, which is not easy, but it's worth it.